ladies and gentlemen. I trust you're keeping safe. Welcome to our webinar this evening. We are so lucky that you've tuned in. My name is Grace Nzula. I am a trainer and HR consultant with Atara Solutions, a training and HR consulting firm, and a manager at Panessa Training Institute, a carpentry school. Get It Right with Atara Solutions is a platform where we demystify issues to do with entrepreneurship and employment. We are in partnership with Zalego Academy, a software development and capacity building academy. We are also in partnership with NG Support Services, a brand management company. This is our 5th webinar. We started with how to register your business legally, brand management and communication. The second webinar, we sought to answer the question, what business do I need to start? Then we had Mr. Panessa, who shared with us his journey in running a business for over 40 years. Last week, we had the pleasure of hosting Mr. Karundu, who defined for us what customers want. He also was generous enough to award his book to 2 of our loyal listeners or audience, or I don't know what to call them. And the books went to Mr. Alan Origa and Rebecca Mose. Congratulations, guys, and thank you for being loyal. Keep tuning in, and I hope you keep learning. If you missed any of our webinars, please go to our YouTube channel, Atara Solutions, that's A-T-A-R-A-H Solutions. And while there, kindly subscribe. Next week, our guest shall take us through business strategies. For those who are joining us today for the first time, allow me to share some facts. Do you know that 22% of businesses fail in the first year, 30% in the second year, 50% in the 5th year, and 70% by the 10th year? And this is what this is the narrative we are trying to change or improve on at Get It Right with Atara Solutions. So this week I was reading a book on the 7 principles of effective management. And one of the things that caught my attention is making data-based decisions. If you're a serious entrepreneur, you cannot run your business unless you understand the facts. One of the key and important facts that you need to keep tabs of and you need to understand and be present with is your finances. We cannot run away from it. And it is probably one of the things that keep us going in business. So to be able to be competitive and successful, bookkeeping is a must. Now, we live in Kenya. All businesses are governed by the law of the land. And that's where the taxman comes in. Like it or not, understanding your obligations from a tax perspective, whether you're an employee or an employer, it is a cure to a lot of headache. So to take us through we have brought in one of the industry's best for this matter. And we have the pleasure, I take this pleasure with a lot of pride, of introducing Mr. Joseph Wanjau Njuguna, who is, please allow me to repeat that. He is Mr. CPA-K Wanjau Njuguna, who has been in this profession for over 15 years. Joseph happens to be a personal friend. I met him probably 13 years ago. And when I talk of him as an expert, I know what I'm talking about. So Joseph, please educate us today.
Okay, thank you very much, Grace, and good evening, viewers and listeners. I think it's a great pleasure for me to be in this panel. Basically, to take you through, as you've heard, my name is Wanjau Njuguna, and I've been a practicing accountant for the last 15 years, and also a finance manager in an institution. Now, I think, let me take you through from my point of, from what Grace has just explained to us. I think most business owners make mistakes when they start businesses because they mix personal finances and business-related finances. To avoid these mistakes, record keeping is key, and a very important tool for you to be able to evaluate your business. I want to take us, I want us to look at a very simple way of bookkeeping or record keeping for business transactions. And to start with, I will just look at the basic bookkeeping transactions as in their classification. To start with, I will start with the basic classifications. There are around 5. That's assets, liabilities, incomes, stroke revenues, expenses, and capital profits and losses. I will start with what we call the subsidiary books. They are very simple to maintain. One of the subsidiary books that I will talk about is the cash book. I know most of us have heard about a cash book, and most organizations probably keep a cash book, but they are not aware that it's actually a cash book they are maintaining. Cash book normally has 2 sides. That's the debit and the credit side. But I will use simple terms so that I don't confuse our viewers. Sometimes are basically used by accountants. It has, let's say, it has the left-hand side and the right-hand side. The cash book, as it talks about, it's basically more of a book where we record cash transactions. By cash transactions, I don't necessarily mean where hard currency is exchanged, but basically is where we record both hard currency and what goes in through either the bank or out of the bank. I've said that the cash book has 2 sides, the left-hand side and the right-hand side. I don't want to use complicated terms so that all of us can be on the same page. The left-hand side is what we call the debit side. This is where we record mostly the incomes, basically the receipts. And the left-hand side, the right-hand side, this is where the credit side, this is where now we record what we call now the payments. That is, if you receive payments, you record them on the right-hand side, on the left-hand side. And if you make payments, you record them on the right-hand side. I think up to that level, we are able now to differentiate the 2 sides. That's both the debit and the credit. But there is something else I also want to mention when we talk about the cash book. Most of when we are entries in the book, there are elements we normally call vouchers. Vouchers is where probably most organizations record, is where most of the organizations record what is called, when you've reached that particular point of payment, where you give the details of what you are paying for and the purpose, whether it's a purchase or it's just a service you are paying for. And when you are doing this, there is basically what now you record on your right-hand side as a payment. But then you also, when you make sales, regardless of whether it's a good you've sold or it's a service, you normally record them on the left-hand side. That's when you issue a receipt, for instance, and you remain with your carbon copy. What has remained with you is what you normally now record on this other left-hand side. But for me not to dwell in more on the cash book, there's also something else I want to mention regarding the cash book. I know most of the times you've in organizations or during your day-to-day running of activities, you've had people saying that I wanted to reconcile my cash. And one of the books that is normally reconciled, which most employers and people who are in business try to reconcile, is the cash book. The reconciliation basically arises because there are some transactions that have been carried out in the cash book, but you cannot actually trace them way back to the bank. Because as I have said, you deal with both cash and at the same time you are dealing with the bank. So there are some transactions that will be in the cash book and they are not in the bank. At the same time, there are some transactions that will be in the bank that they are not in the cash book. For example, most of us have seen at the end of the month when you go and pick your statement, there are some charges that are charged into your bank. That's the bank charges. You will find that the bank charges will normally not be in the cash book. At the same time, there are instances where you have issued a check for a payment. Yes, you've recorded it in your cash book, but the same check is not reflective or in the bank because what has normally happened, the person you've given the check probably has delayed with the check, and you thought maybe he will take the check within maybe 2 or 1 day for it now to reflect in your bank, but it takes him like 3 or 4 days. There is also another transaction that normally creates the as an reconciling item. Those are now what we call the standing orders. Sometimes we place standing orders in the bank, and at some point, when you are recording your transactions in the cash book, you will not record what is already as a standing order in your bank because either sometimes you don't remember or you don't even actually have the exact date that the standing order has taken place. There are quite a number of items that will not be in both. Now, this is where now at the end of the month, when you take your bank statement, you try and reconcile the cash books to see what is not in the cash book and is in the bank, or what is not in the bank and is in the cash book. I think up to that point, I will not go into how the reconciliation is done, but I think we've all understood why we normally maintain the cash book and the reason as to why we normally conduct the reconciliation at the end of every month. For this reason, it is very important for a reconciliation at the end of every month so that now both the cash book and the bank can have the same amount of figures at the end of the day. There's also another book of original entry I'll mention. It's called a sales book. Sales book is where now you record credit sales. As I had mentioned earlier, the cash book, you record what has come in as cash or what has gone in through the bank. So any item that you have bought on credit, because businesses normally operate on credit, there are instances where you will go collect goods or you will get a service on credit for you to pay later. So those kind of either goods or services obtained on credit, you record them on a sales book. These books are not complicated. It's just the normal black book. You can just improvise a normal black book. That's why I was saying that I would want us to simplify it as much as possible. Then an opposite of the sales book is what we call the purchase book. A purchase book is where now you record goods or services that you have actually sold on credit. So it's just an opposite of what I've just mentioned. That's the sales book. And you record what has come in, what you have sold on credit. Then the other book I will mention is called sales return. For instance, that you have bought items from a supplier, and then you realize that they are not according to your specification. What you would normally do is you will return them to the supplier because they don't fit the specification. For this particular transaction, you record them on on a purchase return book because you've bought, but actually they have not been able to fit your specification. Then the opposite of that is called a sales return book, where you have sold items to a client or a service, but mostly an item you've sold, and then the person realizes that what you have sold to them is also not according to what they had specified. So when those goods are returned, you normally record them now in a sales return book. Then the last but not the least I will talk about is bills receivable book. A bills receivable book is where a business owner records all the sales made by credit and the expectation on when they will receive the payment. So you've bought on credit and you've sold on credit, and also you also record the expected date on when now you will receive the payment. We also have an opposite of the same. It's called a bills payable book. This is where the business owner records all the purchases made on credit and the expected date that they will make the payment. So basically, I think I've touched on around 6 or 7 types of record keeping. And I think up to that level, we maybe to our listeners, you can make some questions, and then after we are through with the presentation, probably we can answer some questions based on that. Now, I think as you had seen in the flyer, we were to speak about 2 things: record keeping or bookkeeping, just the basics. At the same time, we were also to touch on the taxes. I know when we mentioned anything to do with the taxes, for most of our listeners, KRA comes into mind. And I think sometimes this is one of the headaches that most business owners go through, because there are situations where business owners apply for compliance certificates, but at the end of the day, they're not able to get, or especially when they're trying to make tenders. I think in a nutshell, I will just mention something on first on the income tax. In Kenya, income tax is charged for each year upon all the income of a person, whether resident or non-resident. Now, I know when I mentioned resident or non-resident, there are different explanations when it comes to the taxman, who is a resident person and who is not a resident person, who is a non-resident person. For a resident person is an individual who has a permanent home in Kenya or was present in Kenya for at least 183 days in the year of tax, or an average of 122 days in the country in the year of tax for the previous 2 years. Up to there, maybe I can repeat who is a resident person. A resident person is a person who has a permanent home in Kenya. You are either you have a permanent home in Kenya, or you are in Kenya present for 183 days in the year of tax in question, or on an average of 2 years, you are in Kenya for 122 days. That's a resident person. Then an unresident person is someone who has no permanent home in Kenya, or was neither in Kenya for 183 days, or when you do an average of 2 years, he was not also in Kenya for 122 days for the previous 2 years. That forms now an unresident person. Now, based on the 2 issues or the 2 terms that I have mentioned, resident and non-resident, resident people are taxed on worldwide income. That is, if you are a resident of Kenya, that is if you have a permanent home in Kenya, or you've been in Kenya for an average of 183 days in the year of tax in question, or for the past 2 years, you've been in Kenya for an average of 122 days, you are normally taxed on worldwide income. Regardless of where you earn your income, you are supposed to pay your taxes in Kenya. I think this is where most of us now maybe probably have issues with. Probably you work in Dubai, but at the same time, when it comes to 30th of June, you are asked to file your taxes. So bottom line, if you fall in that category of a resident person, you are supposed to pay your taxes in Kenya. Now, after explaining that, I will go straight to what we call corporation tax. Corporation tax is a form of income tax that is levied on corporate bodies, such as limited companies, trusts, cooperatives, on their annual income. That is basically when you do, normally what we do, we call end of year financial reports, and you aggregate, that's income less all the expenditures that are allowable for tax purposes. Whatever comes, falls in, or whatever gains you make as profits, you pay on a percentage. Currently, the percentage is 25%, where now you're supposed to pay that. As far as corporate tax is concerned, I will also mention something regarding the same. There's something called installment tax related to corporate tax. Basically, installment tax is payment of taxes in installment. Assuming in a year of income, let's say, give an example, in 2019, from your company, you made profits. And from that, you are able to pay taxes maybe for, let's say, $1 million. For the following year of income, the taxman expects you to pay installment tax based on what now you are able to earn. Normally, it's done in a simple calculation. You add 10% of what you actually paid, and it's normally paid in installments on specific dates. The first installment is normally paid by the 20th of the 4th month. The second installment on 20th of the 6th month. The third installment or 20th of the 9th month. The fourth installment, 20th of the 12th month. That's by December. And the balance is normally paid on or before 30th of April the following year. So assuming you are paying installment tax for, let's say, 2020, for instance, you will pay the first installment in the 6th month, that is in June 20th. No, the first installment you will pay by 20th of the 4th month, that is in April. The second 20th of June, and the third 20th of September, the fourth 20th of December, and the balance you are supposed to clear it the following year, on or before 30th of April. Going forward, I think I will also mention something to do with other than just limited companies. I know we also have businesses that are owned just by registering a business name. Those businesses are considered to be as sole proprietorships. And the taxes of those businesses are normally based on individual tax. So as an individual owner of the business, you would normally now, when you are doing your final returns at the end of the year, you are supposed now to declare what you actually earned from your business, and the taxes are normally charged from your individual PIN, unlike the limited company which have independent PINs from the owners. The other issue is on partnership. Partnerships normally are also supposed to file their annual returns. But at the end of the day, normally what happens, the taxes of the partnerships are also considered to be the taxes of the partners. That is, at the end of the year, when you do the aggregate and you are able to share on the profits, this is the time now when you are supposed to declare what you earned as the profits from the partnerships. Now, I think for me to be, I'll move a bit faster. There is something we call pay as you earn. I know most of us have heard of it, or those who are in formal employment normally pay as you earn. Pay as you earn is tax, it's called tax, it's normally a tax at source. What normally happens with pay as you earn is when you are paying your employees, you subject their pay to something we call the graduated scale rates. That's for the first, let's say 10,000, you pay this much. For the next, between 10,000 to 15,000, there is normally a percentage. And at the end of the day, the pay as you earn is paid on or before 9th of the following month of the period of which now you've actually paid your employees. So if you've paid your employees salaries for the month of June, their pay as you earn is supposed to be paid for in the following month, on or before 9th. I will mention something to do with withholding tax. I know most of the people who are in formal employment, sometimes depending on your profession, we normally conduct what we call side hustles, and most of the side hustles are basically on consultancy. So what normally happens is when the person paying you, after you issue an invoice to an organization, when they are paying you, they would normally withhold what we call a fee from what you have actually billed them. Normally, withholding tax, depending on the business you do, they range between 3% to 30%. And normally, because most people who are in consultancy are in either professional fees, management, or agency, the withholding tax rate is normally around 5%. So you would, when you issue an invoice, if it's, let's say, for 100,000, you would normally get probably less. And then the person who was paying you, they will give you a withholding tax certificate, so that by the end of the year, when you are doing now your returns, you consider that as some tax that you had paid in advance. There's also a tax we call advance tax. Advance tax is normally charged on PSVs, and basically what happens is when you are doing when you've taken your vehicle for inspection, normally this is one of the taxes that you normally pay in advance before your vehicle is inspected. Currently, I think it's around 750 Kenya shillings per seat. So you will just multiply by the number of seats, and then you pay directly to KRA for now your vehicle to be inspected. The last one, but not the least, we'll talk about is called the rental income tax. I know it has been a thorn in the flesh for people who own rental property on what is charged to, what you are supposed to pay for on the rental income. The rental income tax is normally paid at 10% on the gross rent payable monthly. So what you're supposed to do on every month, whatever you've received, if you own a rental house, you're supposed to do 10% of what you have been able to earn, and you pay that directly to KRA. The other type of tax I think I also need to mention about is value added, VAT. I know quite a number of us who are in consultancy and other businesses, depending on what you do. There is usually, normally KRA guys sometimes will pop into your business and ask you to show them probably whether you normally do ETR receipts. VAT is normally charged depending on the type of business you do, or depending on a threshold of how much you make on an annual basis. if you are in any business and you are you make more than 5 million in a year, you are supposed to be registered for VAT. So basically, what that means is you either supposed to be charging VAT on either goods or services. I will touch something on capital gains and capital gains tax. Capital gains tax is tax chargeable on whole of a gain which accrues to a company or an individual upon transfer of property situated in Kenya. I know sometimes this is where most people have a push and pull with KRA when it comes to capital gains, because what basically it means is, assuming I bought some land at, let's say, 1 million, and at the end of the day, when I dispose of the land, I sell it at around 2 million. I'm supposed to pay capital gain on the difference of what I have actually made. So it's a tax on what you've made as a profit from a sale of a capital property. That's the reason as to why it's called capital gain. I think as far as also the taxes are concerned, I will reach there. I know questions must be coming from all corners, and I think Grace, we can go ahead and now people can shoot their questions, because I know these are some of the areas that normally are thorn in the flesh to many business owners.
Thank you very much, Wanjau. You've really given us a summary. And I know we cannot finish this topic today, so thank you for the introduction. I know we will organize another one later. So we had received a few questions previously, and one of the our audiences is asking, I would love to know the implications of the amendment of income tax to small startups or businesses. That is, the law that one has to remit taxes when making losses.
I think as far as making losses is concerned, if depending on, I'm very sure maybe the listener is either registered for what we call turnover tax. Mm-hmm. No, turnover tax is a tax charged on what you have raised on your turnover. Mm-hmm. It's normally on a percentage. Okay. So basically what I would advise as far as that is concerned is depending on whether it's a limited company or an individual, mm-hmm. the best thing will be where now you are registered as a normal taxpayer, where you aggregate expenses, or you charge expenses from your income, because any business that normally pays tax based on their profits they make, mm-hmm. what normally happens is if you make losses, the losses are brought forward to the following year, up to, I think, a period of 4 years. Mm-hmm. Assuming I make a loss in the previous year, mm-hmm. and the following year, let's say I made a loss of 1 million. Mm-hmm. Then the following year, I make a profit of 500,000. Mm-hmm. The losses are brought forward, so that at the end of the day, you will still be in a loss of 500,000 the following year. Mm-hmm. And the losses are pushed forward for the next maximum of 4 years. So mm-hmm. the best way of handling businesses as far as now taxes are concerned, mm-hmm. is you avoid registering for taxes that are a bit, I would not say punitive, but turnover tax is a very simple way of handling taxes. But in a situation where now you've not made any profits, what happens? It means you are still obligated to pay the taxes, because the tax is charged on your turnover.
So do they remove the tax obligation, or what happens? Or this is where they engage a tax consultant?
If you can be able to project and see that for the next 2-3 years, my position as far as my profits are concerned, I will still continue making losses. The best thing is to remove the obligation, so that now your business is only charged on what you make as profits, rather than being charged on your turnover.
Okay. So another one had sent a question previously and asked, we run an errands company. Should we file for VAT returns because our company PIN has a VAT obligation? This was a requirement when we were registering with Communications of the Authority of Kenya. Oh, this was asked by Faraja.
Okay, if you, because I had mentioned something to do with the VAT.
Yes.
VAT normally you are charged or you are registered for VAT if you fall within certain thresholds. I think I've mentioned if you have a turnover of more than 5 million in a year, then you are eligible for VAT registration, or you are eligible to charge VAT on the services you give to your clients. Or if you fall within the threshold of, there are certain businesses that it's a requirement for you to register for VAT. People who are in consultancy is mandatory for you to to register in VAT. And the list is quite long. I can't mention each and every business, but if you fall within that threshold of either you are in vertable services or you fall within the threshold of 5 million turnover per year, then it's a requirement. But if you don't fall within those requirements for registration of VAT, the best thing is for you to remove the obligation. It is very simple. You just write a letter to KRA and it's simple. They will just remove it.
Okay. So another one is anonymously asking, what about catering or food business? How do you do it? What is considered as stock in that case?
What is considered, pardon?
As stock in catering or food business.
What is considered as stock?
Yeah.
I think in catering business, there is quite a number of things you will consider as stock. I'm trying to assume in catering, you do all manner of, you prepare food.
Yes.
And when it comes to food, basically things like flour form part of your stock. And yeah, so at the end of the day, there are quite a number of things that you buy. Some of them are perishable. They would still form part of your stock, and some of them can stay for quite some time.
Okay. So how do you tax an employed individual who is also a consultant in different firms?
An employed individual. First, for an employed individual, they are subjected to pay as you earn from the point of employment. So the employer remits or deducts the tax at source. But at the same time, when they do their consultancy business, there is normally what we call, what I had mentioned earlier, the withholding tax.
Yes.
So what will happen is from the person making the payment, they withhold a certain percentage of the fees. But at the same time, what you are required to do when you are doing now your final return at the end of the year, you are supposed now to aggregate from your consultancy, what were your expenses and what were your profits, so that now, apart from what you've paid as employment income, you are also supposed now to pay tax based on what you have earned from the consultancy.
Yes.
Yeah, because any form of income or allowances from within a year of income is supposed to be charged taxes.
And Joseph, you probably could clarify the issue of claiming VAT. So you please, maybe you can take us through briefly on VAT and how to claim VAT.
Okay, VAT, as I had said, that depends on where you fall in, whether you fall in within the threshold or you fall in under the vertable services. But at the same time, with the VAT, is normally considered, most people, what the mistakes they do, they think if I give you an invoice on VAT, with the VAT amount, whatever comes in is for the business. That is usually very wrong. Because what normally happens is VAT is usually not your money. It belongs to the taxman. So what happens is VAT gives business owners some leeway. There is what we call input and output VAT. So assuming you've charged VAT to, you've received money plus VAT, what you're normally supposed to do is there are items that you will buy that are vatable. At the same time, there are services that you will pay for that are also vatable. So basically what you're supposed to do is you're supposed to knock them out. What you have received as VAT, with VAT that is, and what you've paid out with VAT. The difference, depending on where it falls in, whether it's a negative or a positive, if it is a positive, that is what you pay to KRA. If it is a negative, then it creates what we call VAT credits. So it means that actually KRA owes you some money. So this is what I think the last 2 weeks you've had the commissioner of the commissioner mentioning something to do is they have given VAT refunds up to a tune of around 5 billion. Basically, this is it. You've actually received less than what you've paid out. So the difference is what now creates the credits. This is what normally the KRA after, if depending on actually what you would want to do, you can go and claim it to KRA and they would do a refund.
Okay, okay. We have quite a number of questions. Another one is anonymously asking, how does, oh wait, this is Joseph. How does a partnership that has its own PIN file its own return? Is it still pegged on partners' incomes?
Yes, for a partnership, normally, initially they never used to give partnerships PIN. But of late, they have been giving partnerships PIN. I mean, that's Kenya Revenue Authority. And what normally happens is for a partnership, you normally, as a partnership, it's supposed to file its annual returns. That's the annual taxes. But then when it comes to tax payment is normally based on what the partners have actually shared. So assuming the partnership made, let's say, some profits, and then the individuals or the partners share the profits equally, which is basically the rule. They're supposed to pay to share that's the profit equally. When they share the profits, it's now the individual partners to make sure that they have actually declared whatever they have earned and pay taxes based on that.
Excellent, excellent. Mary Wanjira is asking, is installment tax compulsory?
Installment tax is not compulsory. But,
and she, okay, let me continue her question. Can I pay corporation tax and avoid paying installment tax? Sorry.
I think when I was mentioning something to do with the installment tax, I mentioned that installment tax is tax paid based on what you earned the previous year. It is normally a requirement from KRA that if you have made profits the previous year and you've paid taxes based on those profits, the following year, to help you manage your cash flows, it's a way of, it's an incentive trying to make business owners and company owners manage their cash flows. Yes. For you now for you to make sure that by the end of now the following year, you've paid all your taxes at a very comfortable level, this is where now they introduce the installment tax, where you pay your taxes in bits. You don't necessarily have to wait until the end of the year and you pay the taxes. But if you actually made profits, as I had mentioned the previous year, it's normally a requirement that you now start filing for installment tax based on what you have you had made or based on what you had paid. What you normally do is you subject that to an increment of 10%. But if you are able to prove that the following year you are not able to make any profits, now that's another issue, because it all depends with how you are able to prove to the taxman that from my projections, I'm not able to make profits the following year.
Okay. We may need to move a bit faster, Wanjau, on the answering of the questions so that we are able, there are so many questions. We will keep the questions for later so that we can answer, we can have a Q&A on KRA in other webinars to come. Vishal is asking, I have a business which is registered to sell goods with VAT, but some of my customers are below the 5 million bracket. And in most cases, they decline to transact because they don't want to charge VAT. What is the way out?
I think now, based on that, it depends. What would happen is you will bear the brand of you will not have the opportunity of claiming what is supposed to come into you, so that now you knock what you've actually received versus what you've paid out.
Okay. Icon is asking, what happens if you have VAT fines? Can you be spared by KRA?
It depends on why the fines have been accrued. If it is non-failure to file for VAT, then what basically happens is you can go and explain yourself to KRA. But normally what happens is they would request you to file for a waiver. But then you have to be very convincing on the reason as to why you are filing for a waiver. For them now to either remove the waiver from your iTax ledgers.
Okay. Someone, Geoffrey is asking, I'm a land broker or middleman. Should I pay tax?
Yes.
James is asking, what is money laundering?
Okay. Money laundering is trying to wash money. I will just use simple terms. Where money has been acquired illegally, and most people, what they normally do is they try to wash the money. I will not use the Nigerian term wash. What people would now try to invest in legal businesses for the money now to go through the bank.
Yeah. Okay. So Philip is asking, at what frequency do I file tax returns for sole proprietorship?
Sole proprietorship, the taxes of a sole proprietorship are considered to be the tax of the owner. So when you are doing your final year returns, you are supposed to declare what you have made from your sole proprietorship and pay taxes on that.
Excellent. Thank you very much, Vincent Sila. He's an auditor. I'm seeing he's helping me answer questions. Please, thank you very much so that we are able to take more questions. Do you register for VAT if your yearly turnover is not 5 million and below? Wilpet consultants are asking.
Okay, if your turnover is less than 5 million, then the next thing will be, do you fall in within now the taxable or the VATable either services or goods? If you fall in within those, then you are supposed to register.
Okay, Andrew is asking, I formed a consultancy side hustle under a company name. There are months where there is no business. Do I have any monthly tax obligation? Can one suspend a company temporarily?
There are months that there are no income. But at the end of the day, there are months that there are income. Yes. So what normally happens is, as I had explained regarding corporate tax, it's normally paid at the end of the year. So you are supposed to file your returns, that is make sure that you have financial statements audited. And then from there, now you will be in a position to determine whether you are eligible to pay taxes or not.
Okay. James is asking, James Mukoya, how is civil and engineering works defined when it comes to 3% withholding tax?
Civil and engineering works falls in under consultancy. And those are that's in that category, they fall in under the 5%. I believe maybe he was talking about construction. I'm not sure whether he's in construction or he's in consultancy. But if he's in consultancy, withholding tax is normally 5%. But if he's in construction, it is 3%.
Okay. So Maureen is asking, receipts are the supporting documents, but in the cases where the vendor doesn't issue them, e.g. Mamamboga or small-scale farmers, etc., how do I, the reseller, satisfy KRA that the profits or losses indicated are the truth?
I think when we were starting, I mentioned something to do with the cash book. It is very simple. You can just create a normal, you know, the normal book that is with the shop guy.
The shopkeeper, yes, yes.
Yes, the shopkeeper. It's
Yes.
very simple. You can be able to do that because not all businesses are able to issue receipts.
They keep a book. The one you mentioned,
you
the
keep
small
a book
books,
where
yes.
now you record your daily sales versus maybe your daily expenses, depending on whether you also receive, you also take receipts or receive receipts from the people who normally supply you with the items.
Okay. So someone is asking, how is it possible to reverse? No, just 1 minute. Irene is asking, I have 3 employees who earn 15K monthly. Are we supposed to submit payee?
As far as payee is concerned, I think recently the threshold for payee or people who are eligible to pay payee was increased to a maximum of 24,000, minimum that is of 24,000. So if your employees earn around 15,000, they're not eligible to pay as you earn.
Okay. And then someone else is asking, what is the implication of declaring vatable sales way later after you had issued the invoice? That is generating an ATR receipt with different dates from the invoice.
That will attract a penalty because assuming when you gave out the invoice, let's say on the 5th,
yes,
and the person you gave an invoice is also vatable, definitely by the 20th of the following month, the person will do a claim to that particular invoice.
yes.
And here you are, when now you are also declaring your VAT, you are declaring your VAT after, let's say, 2 months.
Yes.
That one will attract a penalty because it will create an inconsistency. Basically, what happens with VAT, whatever goes out or whatever comes in to you to your company, if you are claiming for VAT, is supposed to correspond with the person that is also maybe making the payment for VAT. So they are supposed to correlate. That's the invoice, the same invoice number, the amount, and the date.
Excellent, excellent. So Mukaya is asking, are there penalties applicable to understated installment tax?
Not really, because it all depends, as I had explained earlier. It depends with how you are able to explain as far as now maybe your cash flows are concerned. There are instances where you would, from your projection, you would maybe see that in the next 3 months, I'm not able to make what I made in the last 3 months. So probably your installment tax the amount you paid might be lower than the previous one. But what matters is, are you able to explain as the reason as to why you've paid less than what you paid the previous month or the previous period, that is.
Okay. Sharon is asking, to follow up on sole proprietorship, doesn't presumptive tax suffice?
Pardon?
Presumptive tax.
Yes.
What is presumptive tax?
Presumptive tax. Presumptive tax is what is normally paid on, let's say, it's something that is normally not consistent as far as maybe the business, more on hobbies. Yeah, so.
Joseph, Catherine is asking, no, Cornelius, sorry. Am I expected to pay any tax after my client has deducted withholding tax from my consultancy fee?
Yes, it all depends on what you have made from the consultancy. Because basically, I don't assume what you've issued as an invoice and what has been withheld as 5% is what you have actually made after you deduct your expenses. So probably at the end of the day, you would still make profit out of what you have actually received. What you're supposed supposed to do is when you deduct your expenses, whatever remains as your profits, you are supposed now to net off from what was withheld. That's the reason as to why every time a withholding is done, you are issued with a withholding tax certificate, because it's more of like tax you've paid in advance. So you are supposed now to do the difference, and then now you pay on the difference.
Okay. Charles Ikwe, and this I think will be our last question. I would like to know what VAT is chargeable for deposits made before VAT change and the goods delivered after the change.
Pardon?
I would like to know what VAT rate is chargeable for deposits made before the tax bracket was changed. Probably, I think he's asking between the 16. He made a deposit when it was 16%, and the goods have been delivered after the change, when it's 14%.
Maybe the question here is, when did he receive the invoice? What's the date of the invoice? Because the invoice date dictates on what rate the VAT will be charged on. Because if the invoice date is after the rate was reviewed, then it means that he's supposed to pay on 14%. But if the invoice date was before, he's supposed to pay on the 16%. Okay.
And then finally, Shiko is asking, I pay presumptive tax. I have a shop and KRA requires that I pay. The badically, they go around ensuring small shop owners to pay this tax. It's a percentage of the fee City Council charges. For 5K license, presumptive tax is 850 shillings. I think she was contributing to the discussion. Icon, what should you do if someone used your PIN for VAT and you never did business with them?
Pardon?
What should you do if someone used your PIN for VAT and you never did business with them?
Then that's illegal. He's supposed to report to KRA if he's aware of the person who actually did that, because it's it's like someone using your to or do an M-Pesa transaction.
Okay. I think what we can do now is we shall have a Q&A session for the taxes and the bookkeeping in future, probably around September or October, but we shall keep you posted. I think our time is up, and I would like to thank you very much for tuning in. We shall definitely have another session like this one. Thank you very much, Mr. Wanjau. That was a very informative session. Thank you, Zalego Academy, our IT partners. Thank you, NG Support Services, our communications and brand management partner. And I would like to congratulate one of our panelists, Mr. George, who launched Pearl Radio 96.9 FM. Kindly tune in and give your support or enjoy the music and the discussions they'll be having. That will be 96.9 FM in Nairobi. Thank you very much, our audience, for tuning in tonight. It's been a pleasure. Keep doing this. We are here every Tuesday from 8 p.m. to 9 p.m. Next week, we shall be discussing a very, very interesting topic that we never see to discuss. Business strategy, sorry. We are discussing business strategies. What strategies are you employing? There's COVID. There has been a lot of changes that happened. So we shall have a very interesting discussion then. Please like our Facebook page, follow us on Instagram, subscribe to our channel, Atara Solutions, and to get the latest updates on what we are up to. I have been your host, Grace Njuguna. See you next week at the same time as we look at business strategies from all of us. It's good night.
Good night.
Thank you very much, Joseph.
Oh,
yeah. Thank you, Zalego. We shall keep your questions and answer them later.